Hello, this video is going to take you through the steps to solve problem 9-1B on page 425 of your textbook. This is very similar to the problem that's assigned in your homework. On April 22nd, they purchased $5,000 of merchandise on credit from Fox. And then a month later, they replaced that accounts payable with a note along with some cash. So we have one note from Fox, and I included that on our list. And on July 15th, we also borrowed some money, Warner did, from the Spring Bank, and that's added to the list for an additional notes payable. And then, let's see, borrowed $8,000 cash from Citibank, and that will be our third notes payable. And the dates in which we signed these actual notes when we made the promise to pay this amount back are listed here. And then the actual days, again, these are days in terms of 1 year. So this is, let me fix that, days. And then for the first one, we're going to determine the maturity date. So for Fox, what we're going to do is we're going to first look at the month of May. And the month of May has 31 days. And since we signed it on the 23rd, I'm going to see. I don't like it. See. So we got 31 days. And we're going to subtract our 23. We're talking about 8 days in May. And the next month is June. So that's 30 more days. And we're trying to account for 60 days. So July, there's 31 days. So since we have 31 days in July, that's going to put us over the 60. And we need, what, 60? So how many more days do we need? Let's go ahead and do 60 minus the 38. And so our maturity date ends up being July 22nd. So let's go ahead and put down July 22nd here. And just keep in mind that I use the knuckle approach, which you make a fist, and you'll see January, March, May, July, and August, October, and December all are on the knuckles. So if you make a fist, you'll see July and August both have knuckles, and those all have 31 days. The valleys, they only have 28. So you can use that to help you remember. And I don't know how I can put this off to the side. So let's go ahead and put the information for, I have spring here. And the date we start off with was July 15th. And again, for our little diagram, July has 31 days. So we're going to go ahead and go with the 31. So July 31, and then since it was on the 15th, we're talking about these are 16 days we're using up in July. Next month is August, and we need to count for, we're going to add, let's see, August, September. September has 30 days, and our running total is, let's see, we need some more days. So September, October, 31. And let's see, we got to get up to 120 since we're at 108. That means 12 more days. So that would be November. And then 12 more days. And that'll put us at 120 days. So our maturity date will be November 12th. And the last one, city. So let me go ahead and erase this stuff. Citibank. So for December, we have 31 days, and we're going to go ahead and subtract the date. So December 6th, so the 6th. So how many days did we use up in December? Well, looks like 25, right? So 31 minus 6 gives me 25 days, and I need to account for what? 45 days, so that's how many more days? 20 more days, and that would mean that January 20 would be my date of maturity. And just to kind of show you that it did work out, we'll add those two numbers up together, equals some 45 days. And so our maturity date, January 25. Alrighty, so that's number one. Number two, it asks us to determine the interest due at maturity for each of the three notes. Assume a 360-day year. So determine interest due at maturity for the three items in question. 4,600 is the principal. For the Fox, 15% is the annual interest rate. And time in terms of a year is 60 divided by 360. Since they told us to use 360 for the number of days in a year, even though there's actually 365 or 366. I use the standard formula P times R times T equals interest for this length of time. So all we're going to do is multiply our principal by the annual interest rate times the total days within the term. So the 4,600 times the 15% times 60 divided by 360, we get 115 for the interest. We'll do the next one, 12,000 times the 10% times 120 divided by 360. We get 400, and then finally we'll take the 8,000 times the 9% times 45 divided by the 360, and we should get $90 for the interest. So the grand total, if we add them all up, sum of these three, 605. And then item 3, it says determine the interest expense to be recorded in the adjusting entry at the end of 2014. So in 2014, we want to see if there's any items that did not mature. Going back to our list, this one matured in July, spring matured in November, city is the only one that has not matured. So we're going to look at from the period of December 6th through December 31st. December 31st. And that would be what, 25 days? City. So 8,000, and our interest rate was 9%. And our time was 25 days over 360. So our interest would be equal to 8,000 times 9% times 25 over 360. And that total for that period is $50. And this would be the amount that we would record as our adjusting entry. And then item 4, determine the interest expense to be recorded in 2015. So in 2015, we only have the city Fox that has what? We've only used up 25 days in December. The other 20 days will be in January. So to do that, we will use our same 8,000, our 9% interest, and our time. This time we're talking about 20 days, and this is 20 over 360, and our amount would be equal to 8,000 times the annual interest rate times the number of days in 2015 over 360. And I have to write it out because it's not an actual number on my spreadsheet. 20 divided by 360. Okay, and that gives us 40. So the $40 in interest for 2015, and we have $50 in 2000, and I'll make it a little small so you can see 2014. So 50 plus 40 equals our grand total of 90 for a city. So even though it's 45 days, part of it relates to 214 and the other part relates to 216.